You may hate the man, you may despise everything he stands for, but here's what you cannot deny. Donald Trump rewrote the rules of business negotiation in ways that made him billions and left a trail of wreckage behind him. And whether you're building your first business, negotiating your next deal, or simply trying to understand how power actually operates in the real world, these 5 moves reveal something most business schools will never teach you. They reveal what happens when someone decides that conventional wisdom is for conventional people, and that winning matters more than being liked. I'm not here to defend him. I'm not here to condemn him. I'm here to dissect the mechanics of how a real estate developer from Queens turned controversy into capital, bankruptcy into leverage, and chaos into a negotiating weapon. Because here's the uncomfortable truth. These tactics worked, not all the time, not without casualties, but they worked often enough to build an empire that survived multiple near-death experiences. And here's what separates you from the ultra-wealthy right now. They understand that business is not a gentleman's game. It never was. The rules you think exist, they're suggestions. The contracts you think are sacred, they're starting points for negotiation. The assumption that everyone operates in good faith, that's the luxury belief of people who've never had to fight for survival in a billion-dollar bankruptcy negotiation. So let me ask you something right now before we go any further. Are you ready to see how business actually works at the highest levels? Are you prepared to understand tactics that exist in the gray areas between genius and ruthlessness? Because once you see these moves, you can't unsee them. You'll start recognizing them everywhere, in the deals your competitors are making, in the negotiations happening in boardrooms across the world, in the strategies that separate billionaires from millionaires. If you're serious about understanding real wealth strategy, not the sanitized version they teach in business school, but the actual playbook used by people who've reshaped entire industries, then do yourself a favor right now. Hit that subscribe button. Because what I'm about to reveal isn't just about Trump. It's about the fundamental mechanics of power, leverage, and strategic ruthlessness that the ultra-wealthy deploy every single day. And if you miss next week's breakdown, you're leaving money on the table. Simple as that. Now let's get into this. Move number 1. And this is where Trump violated every rule in the negotiation handbook. Conventional wisdom says you negotiate from strength. You build leverage. You position yourself as the valuable party in the transaction. Trump looked at that wisdom and did the exact opposite. He negotiated from weakness by flooding the zone with chaos. Let me paint you a picture. It's 1990. Trump's Atlantic City casino empire is collapsing. The Trump Taj Mahal, which Trump had personally called the 8th wonder of the world when it opened, is now drowning in $1.2 billion of debt. The casino can't make its bond interest payments. Default triggers are firing. Bondholders are circling. Banks that financed this monument to excess are watching their investments evaporate in real time. Here's what a normal person does in this situation. They disappear. They hide. They bring in crisis management consultants who tell them to be humble, be apologetic, negotiate from a position of weakness because, well, they are weak. Trump did something completely different. He weaponized the crisis itself. He walked into those negotiation rooms and made one argument that changed everything. He convinced the lenders that losing him meant losing everything. Not just losing the casino, not just losing their investment, losing any hope of recovery whatsoever. Because without Trump's name, without Trump's management, without Trump's ability to generate publicity and attract gamblers, the Taj Mahal was just an oversized building in Atlantic City with no customers and no future. Think about the audacity of that position. You're $1 billion in debt. You've defaulted on your payments. Every financial metric says you've failed catastrophically, and you walk in and tell the banks that they need you more than you need them. That's not negotiation. That's psychological warfare, and it worked. In October 1991, the Taj Mahal emerged from bankruptcy, with Trump retaining 50% ownership. He only ceded 50% to bondholders in exchange for lowered interest rates and extended payment timelines. Read that again. Trump took what looked like total financial annihilation and converted it into a restructuring deal, where he remained the control holder despite near-total failure. This is the principle that separates people who build generational wealth from people who lose everything in their first major crisis. When you're weak, You make the other side believe they're weaker. You don't negotiate from your actual position. You negotiate from the alternative scenario. And you make that alternative scenario so terrifying that your weakness becomes leverage. Trump forced those creditors to imagine what happens if they seize the assets. They get a half-finished casino with Trump's name on it, but without Trump to run it. They get a property in a saturated gambling market with no unique draw. They get litigation, liquidation, and pennies on the dollar. Suddenly, keeping Trump at 50% ownership doesn't look like a concession. It looks like the least bad option. Now here's where this gets even more savage. This wasn't a one-time move. Trump repeated this exact pattern. In 2004, another bankruptcy filing, another $1.8 billion in debt. And once again, Trump restructured his way to survival, this time retaining 10% ownership despite owing hundreds of millions. He had turned bankruptcy from a failure into a business model. But let's talk about what this actually cost, because here's the part that should make you deeply uncomfortable. More than 400 Trump casino employees lost over $2 million from their retirement accounts when the company forced them to sell employee stock at massive losses during restructuring. Contractors went unpaid. Small vendors went bankrupt. The burden of Trump's financial failures fell on the people least able to absorb the loss. This is the ethical minefield at the heart of this strategy. It works. It preserved Trump's position. It allowed him to survive multiple near-death experiences. But it transferred the pain downward, to employees who'd invested their retirement savings in the company, to contractors who'd completed work in good faith, to small businesses that couldn't afford to write off hundreds of thousands in unpaid invoices. So here's the question you need to ask yourself. Could you execute this move? Not would you want to. Could you? Because it requires something most people don't have. It requires the ability to walk into a room where you're objectively weak, where every number on every spreadsheet says you've lost, and convince everyone else that they're the ones who should be afraid. It requires complete emotional control, zero apology, absolute conviction that the alternative is worse for them than it is for you. And here's what most entrepreneurs miss about this. Trump's genius wasn't in the negotiation itself, it was in the setup. He had positioned himself as indispensable before the crisis hit. His name was on the building, his face was in the marketing, his management team ran the operations. He'd made himself so central to the asset's identity that removing him damaged the asset's value. That's strategic positioning that begins years before you need it. The ultra-wealthy understand this principle in ways that regular business owners don't. They don't just build businesses, they build dependency. They make themselves the irreplaceable component. So when crisis comes, and crisis always comes, they can negotiate from weakness as if it were strength. Now, if you're watching this and thinking about your own business, your own deals, your own negotiations, leave me a comment right now. Tell me about the last time you negotiated from weakness. Did you position it as strength? Did you make the other side more afraid than you were? Or did you capitulate because you thought weakness meant you had no leverage? Because I want to know where you are in this journey. I want to know if you're ready to think like the people who actually win these games. Move number 2. And this one completely inverts how most people think about litigation. Most business owners see lawsuits as defensive tools, something unfortunate, something you're forced into when negotiations break down. Trump looked at lawsuits and saw an offensive weapon, a business strategy in itself. Let me give you the case study that perfectly illustrates this. Trump University, a for-profit seminar operation promising to teach Trump's real estate secrets. When lawsuits started accumulating from attendees claiming false advertising and fraud, Trump didn't do what most defendants do. He didn't settle quickly to make it go away. He fought, aggressively, for years, publicly insisting he would win in court. Now here's what most people miss about this strategy. The lawsuit itself became the negotiating mechanism. Every month that lawsuit dragged on served multiple purposes. It delayed any payment obligation. It exhausted plaintiffs' resources. It maintained Trump's control over the public narrative, and it forced the other side to keep spending legal fees. Think about the game theory here. You're a plaintiff. You've paid thousands of dollars for a seminar that you believe was fraudulent. You sue. Now you're in litigation against an opponent with effectively unlimited legal resources. Every month costs you money. Every deposition costs you time. Every motion costs you psychological energy. And your opponent? He's got a legal department on retainer. The marginal cost of fighting you is basically zero. So what happens? You get exhausted. You start questioning whether you can afford to keep fighting. You start wondering if settlement for 50 cents on the dollar is better than risking years more litigation with no guaranteed outcome. Trump knew this. He built his litigation strategy around the asymmetry of resources. By the time Trump settled the Trump University case in 2016 for $25 million, without admitting wrongdoing, he'd absorbed years of media coverage and extracted maximum leverage. And here's the kicker that came out later. The settlement wasn't even paid by Trump personally. It was paid by his Las Vegas hotel business partner, Phil Ruffin, who claimed it was for back fees. Trump had turned a personal liability into someone else's expense. This pattern extended far beyond Trump University. Trump's approach to contractor payments is where this strategy gets truly systematic. More than 60 lawsuits have been filed by individuals and businesses, accusing Trump of failing to pay for work completed at his properties. His response wasn't swift settlement. It was protracted legal warfare. Take Free State Electrical. They sued Trump's organization for failing to pay $2 million for electrical work on the luxury hotel in Washington, D.C.'s old post office building. 4 other contractors sued over the same project, claiming nearly $5 million in unpaid bills combined. Trump's team didn't write checks. They filed countersuits. They questioned work quality. They dragged everything through complex legal maneuvering. Here's the business principle underneath all of this. Litigation costs the opposing party money and time. If you have deeper pockets and more legal resources, you can often force settlement on your terms, not theirs. Trump understood this asymmetry better than almost anyone in American business. But let's be crystal clear about the shadow side. This strategy disproportionately punishes small contractors and service providers. New Jersey regulators found that Trump failed to pay at least 253 subcontractors in full or on time during the 1990 Taj Mahal construction. We're talking about electricians, plumbers, small fabrication shops, people who don't have legal departments, people for whom $200,000 in unpaid invoices could mean bankruptcy. So here's the lesson that makes most people uncomfortable. The legal system is not neutral. It favors whoever can afford to stay in the fight longer. Justice and leverage are not the same thing. The person with more resources can often outlast the person who's technically correct. Trump weaponized this imbalance. He turned litigation from a dispute resolution mechanism into a business negotiation tool. He made the lawsuit itself so expensive and time-consuming that settlement on his terms became the rational choice for the other side, even when they were right. Now, most of you watching this don't have unlimited legal resources. You're not going to outspend your opponents in protracted litigation, so does that mean this strategy is useless to you? No. It means you need to understand it so you can recognize when it's being deployed against you. If you're a contractor negotiating with a large corporation, you need to know they might use payment disputes as leverage. If you're a small business dealing with a bigger partner, you need to understand they might have litigation as a strategic option that you don't. Knowing this changes how you structure contracts. It changes when you demand payment. It changes what leverage you build into deals before you start work. The ultra-wealthy don't just use the legal system. They understand its economics. They know that justice and who can afford to keep fighting are often the same thing. And they structure their entire business operations around that reality. Move number 3. This one is pure psychological warfare disguised as marketing. Trump's most underrated genius is his understanding that perception precedes reality. He doesn't just build properties, he manufactures mythology around them before a single brick is laid. Let me take you back to the mid-1970s. Trump decides to build the Grand Hyatt in Manhattan. He's not just refurbishing an old hotel, he's creating a legend. And here's how he does it. He relabels the floor numbers, so the 6th floor becomes the 14th floor. He manufactures claims about it having the largest ballroom in the city, completely false. He builds a narrative before the property is even completed. By the time customers show up, they've already absorbed the mythological version of the hotel. The hype preceded the delivery. And here's the savage part. It worked. Because most people don't fact-check marketing claims. They absorb the story. They believe the narrative, and by the time they experience the actual product, their expectations have already been set by the mythology. Trump replicated this with Trump Tower. Marketed as rising to a 68th floor when it actually had 58. Falsely billed as the tallest concrete structure in the world. These weren't mistakes. They were calculated hype engineering. And Trump himself was completely explicit about this strategy in his 1987 book, The Art of the Deal. Here's what he wrote, and I'm paraphrasing the core idea. The final key to promotion is bravado. Playing to people's fantasies. A little hyperbole never hurts. People want to believe something is the biggest and the greatest and the most spectacular. He called it truthful hyperbole. Let that sink in for a second. Truthful hyperbole. That's not an oxymoron to Trump. That's a business strategy. You're not lying. You're exaggerating truth in service of the fantasy people want to believe. This approach extended to product licensing and became one of Trump's most lucrative strategies. His licensing deals generated $225 million in annual retail sales at one point. Trump ties, Trump steaks, Trump water, Trump condominiums. He licensed his brand aggressively, often before the underlying products or properties were fully operational or even profitable. Here's the case study that reveals how far this can go. The Mexico Trump Ocean Club project, announced with massive fanfare, prestige positioning, Trump's personal brand behind it. The project generated nearly $300 million in pre-sales and deposits from buyers excited about the Trump brand promise, before anyone knew whether Trump could actually secure construction financing. Spoiler alert, he couldn't. The project never materialized, but Trump had already extracted value from the brand hype itself. Buyers had committed money based on mythology, not reality, and by the time reality caught up, Trump had moved on to the next project. The business principle here is actually profound. Hype attracts capital, hype attracts partners, hype attracts media coverage. If you can build a narrative that precedes reality, you can negotiate from strength with lenders, partners, and buyers, because they're not evaluating your actual position, they're evaluating the story you've told about your position. But here's where this gets uncomfortable. This strategy assumes the underlying product will eventually deliver something close to the hype, when it doesn't. As with Trump University or failed licensing projects, the strategy reveals itself as a wealth transfer from believers to the hype generator. Trump's personal brand survived multiple failed projects because his brand could absorb individual failures. He could launch Trump Steaks, watch it fail completely, and still license his name to vodka manufacturers a year later. His brand resilience was built on decades of mythology manufacturing. Here's what you need to understand. Most entrepreneurs can't do this. If you're building your first business and you overhype and underdeliver, you're done. You don't get a second chance. Your reputation is your only asset and you just destroyed it. Trump's genius was that he'd built a reputation for hype itself. People expected exaggeration. It became part of the brand. So when reality diverged from mythology, it wasn't a scandal. It was on brand. This is the lesson most people miss. You can't just copy the hype strategy. You need the infrastructure to survive when hype and reality diverge. That means multiple revenue streams. That means brand resilience built over decades. That means a public persona that can absorb failures without collapse. The ultra-wealthy understand that perception is a leverageable asset. They manufacture it deliberately. They deploy it strategically. And they've built the infrastructure to survive when perception and reality eventually collide. Move number 4. And this is where Trump violated one of business's most fundamental principles. He weaponized non-payment as a negotiating tactic. This move shocks most business professionals because it completely inverts the basic principle of contractual obligation. You complete work, you send an invoice, you get paid. That's how business works. Trump normalized using non-payment not as failure, but as leverage. Here's how it worked. Contractors complete work and request payment. Trump's operating principle was straightforward. Withhold payment as negotiating leverage. And he articulated this explicitly. I'm paraphrasing his core argument. If contractors do a job that's not good, or they didn't finish, or they were late, he'd deduct from their contract absolutely. He framed non-payment as quality control, not default. But here's the sophistication underneath this tactic. It sounds reasonable when framed as quality standards, but the application was systematic. More than 200 liens have been filed against Trump or his businesses by contractors and employees dating back to the 1980s. Curtain makers, chandelier shops, cabinet makers, even Trump's own lawyers. Let me give you a case study that illustrates the mechanics. ALM Unlimited had been hired in 2003 to arrange clothing licensing deals for Trump. They'd received over $300,000 during a 3-year period. In 2008, Trump discontinued payments. ALM sued. Trump's defense? He claimed he didn't even look at the checks. He simply stopped payment when he decided ALM's role was insubstantial. The judge ultimately ruled in Trump's favor because there had never been a formally valid contract. And this reveals the deeper strategy. Trump often operated in gray areas where contracts were informal, where scope was ambiguous, where he could claim quality issues or incomplete work or change circumstances. Here's the business principle that most people miss. Payment is leverage. If you can defer or dispute payment while continuing to negotiate, you've essentially gotten an interest-free loan backed by the other party's desperation. Trump understood that contractors and small vendors rarely have the financial runway to wait indefinitely for disputed payments. Think about the game theory. You're a small electrical contractor. You just completed $200,000 in work on a Trump property. You send the invoice. Trump's team says the work was substandard in some vague way, and they're deducting 30%. What are your options? Option 1. You accept the reduced payment because you need cash flow. Option 2. You sue, which means hiring lawyers, spending months or years in litigation, and risking getting nothing if Trump's team finds some contractual loophole. Option 3. You try to negotiate a middle ground, maybe settling for 85% of your invoice just to end the dispute. Trump bet that most contractors would choose option 3. And he was right. Because the alternative was fighting someone with unlimited legal resources and willingness to litigate every dispute to exhaustion. New Jersey regulators found that Trump failed to pay at least 253 subcontractors in full or on time during the 1990 Taj Mahal construction. These were electricians, plumbers, small fabrication shops working on the biggest casino project in Atlantic City. And when the project was finished, many of them had to write off significant unpaid invoices just to avoid the cost of litigation. Here's the structural inequality that makes this strategy work. It depends completely on power asymmetry. You must be bigger, richer, and have better legal infrastructure than your contractors. For small vendors working on a single Trump project, non-payment could mean bankruptcy. For Trump, it was a negotiation strategy deployed across dozens of projects simultaneously. Now, most of you watching this are not in Trump's position. You don't have unlimited legal resources. You're not big enough to systematically underpay vendors and survive the reputational damage. So what's the lesson? The lesson is defensive. You need to understand this tactic so you can protect against it. That means better contracts with specific deliverables and quality standards. That means requiring deposits or milestone payments instead of payment on completion. That means researching whether your potential clients have histories of payment disputes before you start work. The ultra-wealthy understand leverage in ways regular business owners don't. They see every transaction as a negotiation that continues past the handshake. They understand that contracts are starting points, not endpoints. And they've built their entire business operations around maintaining maximum leverage at every stage. Move number 5. This is perhaps Trump's most legally aggressive and strategically brilliant move, the systematic use of corporate bankruptcy to transfer personal losses to public shareholders and bondholders. Here's what separates this from everything we've discussed so far. Trump never filed for personal bankruptcy. Think about that. His businesses filed bankruptcy 4 times, but Trump the person, never. His personal credit remained intact. His personal assets remained protected. He achieved this through corporate structure engineering. Let me explain the mechanics because this is where it gets fascinating. Trump would take on massive personal loans to finance his casino empire. Then he'd have his casinos refinance his personal debt into corporate debt through complex restructuring. When the casinos couldn't service this debt, Trump used bankruptcy law to restructure again. often wiping out or severely reducing obligations while retaining operational control. The 2004 Trump Hotels and Casino Resorts bankruptcy illustrates this perfectly. The company filed with $1.8 billion in debt. It emerged with Trump still in leadership, but with dramatically reduced obligations. And here's the part that should make your jaw drop. As CEO from 2001 to 2005, Trump made approximately $3.2 million per year. That's more than 120 times the average $26,000 annual salary of his casino employees. Let that sink in. The company is hemorrhaging money. It's filing for bankruptcy. Shareholders are getting wiped out. Bondholders are taking massive losses. And Trump's salary continues. In fact, after a 2004 bankruptcy, Trump's salary increased from $1.5 million to $2 million. A Temple University study by bankruptcy expert Jonathan Lipson found that Trump's Atlantic City casinos lost 37% more employees and 33% more revenue than competitor casinos during the same period from 1997 to 2010. They underwent 4 bankruptcies, more than any other major American business. Yet Trump personally profited enormously throughout this collapse. Here's the genius of this structure. It allows you to take massive financial risks without personal consequence. If the venture succeeds, you profit. If it fails, creditors and shareholders absorb losses while you retain operational control and compensation. You've socialized the risk while privatizing the gain. This is bankruptcy law weaponized as business strategy, and it's completely legal. Bankruptcy law is designed to allow exactly this kind of restructuring. But understanding how to deploy it requires sophisticated legal and financial engineering that most entrepreneurs never develop. Trump's approach revealed something most people don't understand about corporate structure. It's not just about liability protection, it's about risk transfer. You create entities that can absorb your personal debts, then use bankruptcy law to restructure those entities while protecting your personal wealth. The ethical calculation here is stark. This strategy transfers risk from the decision-maker to creditors, employees, shareholders, and vendors. Trump made the decisions that led to billions in losses, but he didn't bear those losses personally. The employees who lost their retirement savings bore them. The bondholders who bought casino debt bore them. The contractors who went unpaid bore them. Is this legal? Absolutely. Bankruptcy law explicitly allows this. Is it ethical? That depends entirely on your framework. If you believe the person making decisions should bear the consequences of those decisions. This strategy violates that principle. If you believe business is a game played within legal rules, and winning is what matters, this strategy is genius. Here's what you need to understand about the ultra-wealthy. They don't just understand corporate structure, they understand how to engineer corporate structure to shift risk away from themselves. They create entities that can fail without destroying their personal position. They maintain operational control while transferring financial liability. Most entrepreneurs build businesses where their personal fate and their company's fate are tied together. The ultra-wealthy build structures where those fates are separated. Their companies can collapse while they remain wealthy and in control. Now let me bring all 5 of these moves together, because there's a pattern underneath everything we've discussed. These tactics share one common feature. They work because they violate the assumption that business partners operate in good faith. Most executives assume contracts will be honored, that lawsuits are defensive, that hype precedes honest delivery. That non-payment is an exception rather than strategy. That corporate structure exists to manage normal operations, not to systematically transfer risk. Trump succeeded, and sometimes failed catastrophically, because he operated outside these assumptions. He treated every transaction as warfare by other means. He saw leverage where others saw weakness. He weaponized legal systems that others used defensively. He manufactured perception where others focused on product quality. The question isn't whether these tactics are ethical. They exist in massive legal and moral gray areas. The question is whether you have the psychological infrastructure to execute them. Let me be very direct about what that requires. First, comfort with aggressive confrontation. Trump sued first. He litigated aggressively. He rarely apologized. Most people are conflict-averse. They want to be liked. They want smooth relationships. Trump didn't care. He understood that being liked and being wealthy are often inversely correlated at the highest levels. Second, willingness to endure reputational damage. Multiple failed projects, hundreds of lawsuits, thousands of non-payment accusations. Trump's brand survived because he never publicly conceded wrongdoing. Can you maintain absolute confidence through scandals? Can you continue operating while your reputation is under constant assault? Third, access to superior legal and financial resources. These strategies only work if you can outlast the other side. You need the best lawyers, the most sophisticated accountants, enough capital to fund protracted legal warfare. Most entrepreneurs don't have this firepower, and without it, these tactics don't just fail, they destroy you. Fourth, compartmentalization. Trump separated his company failures from his personal brand. His casinos filed bankruptcy 4 times. Trump the person remained mythologized. His personal brand absorbed his corporate failures without collapse. Can you separate your identity from your business failures? Fifth, understanding that risk is asymmetrical. Trump understood that for most people, a dispute over payment could mean financial ruin. For him, it was a negotiation tactic. He had power differential and he leveraged it ruthlessly. Do you have that differential in your position? These are not rhetorical questions. They're genuine assessments you need to make about yourself and your position. Because attempting these strategies without the infrastructure to support them is not boldness, it's suicide. Let me give you a thought experiment. Imagine you're negotiating with a contractor who just completed $500,000 in work for you. The work is adequate but not exceptional. You could pay the full invoice, or you could withhold 20% and force them to negotiate or litigate. What do you do? If you immediately thought I'd pay the full invoice, you're operating in good faith assumptions. You're assuming contracts are sacred. You're assuming business relationships matter more than marginal profit optimization. If you thought, it depends on whether I have leverage, whether they have resources to sue me, whether I need them for future projects, you're thinking like Trump. You're evaluating the transaction through power dynamics, not contractual obligations. Neither answer is inherently right or wrong, but they represent completely different approaches to business, and only one of those approaches built billion-dollar empires through multiple bankruptcy cycles. Here's what I want you to understand as we close this. The uncomfortable lesson isn't that you should copy these tactics. The uncomfortable lesson is that these tactics exist. They're being deployed right now by competitors in your market, by partners you're negotiating with, by corporations that understand leverage better than you do. The ultra-wealthy don't play by the rules you think exist. They play by the rules that actually exist. Legal boundaries, power asymmetries, resource advantages, psychological warfare. They've built their entire operations around understanding and exploiting these dynamics. Most people go through their entire business careers believing that hard work, quality products, and good faith negotiations are sufficient. And then they get destroyed by someone who understands that business is warfare with spreadsheets. So here's my question for you. In your industry, in your market position, with your resources and psychology, would you have the guts to pull off these moves? Not would you want to. Would you be capable? Do you have the infrastructure, the resources, the psychological makeup, and the ethical framework that would allow you to negotiate from weakness as if it were strength? Weaponize litigation, manufacture hype, strategically withhold payment, and engineer corporate structures to socialize losses while privatizing gains. If your answer is no, that's not a weakness. It might be integrity. But you need to understand that others in your market might answer yes, and that means you need defensive strategies, better contracts, payment structures that protect you, legal resources that prevent you from being outlasted, corporate structures that shield you. If your answer is yes, then you need to ask yourself a harder question. Are you prepared for the reputational damage, the ethical compromises, and the human cost that comes with these strategies? Because Trump's casinos didn't just file bankruptcy in some abstract sense. Real people lost their retirement savings. Real contractors went bankrupt. Real employees lost their jobs while Trump increased his salary. These tactics reshaped Trump's fortune and left permanent marks on the business landscape. Both successful innovations and spectacular failures. Whether you admire or despise them, understanding them reveals how business operates when players abandon conventional assumptions of good faith, loyalty, and reciprocal obligation. The real question isn't whether Trump was right or wrong. The real question is what you're going to do with this knowledge. Are you going to pretend these dynamics don't exist? Are you going to protect yourself against them? Or are you going to deploy them? Because here's the final truth. Wealth at the highest levels isn't built by people who follow conventional wisdom. It's built by people who understand that conventional wisdom is for conventional outcomes. The ultra-wealthy rewrote the rules. They operated in gray areas. They leveraged asymmetries that others didn't see or wouldn't exploit. And now you've seen exactly how they did it. What you do with that knowledge determines whether you stay where you are or whether you break through to the next level. If this breakdown opened your eyes to how power actually operates in business, then I need you to do something right now. Share this video with one person who needs to understand these dynamics. Just one. Someone building a business. Someone negotiating a major deal. Someone who still believes the game is played with the rules they learned in business school. And leave me a comment. Tell me which of these 5 moves shocked you the most. Tell me if you've seen these tactics deployed in your industry. Tell me if you'd have the guts to execute them yourself, because I read every single comment and I want to know where you are in this journey. The people who reach the highest levels of wealth don't just work harder. They understand power differently. They see leverage where others see fairness. They weaponize systems that others use defensively. And now you understand exactly how they do it. The question is whether you're prepared to operate in that world, because once you've seen behind the curtain, you can't unsee it. Welcome to how business actually works at the highest levels. Use this knowledge wisely.